PCE versus CPI. Hello, this is John Rothfield with Derivative Logic. When the Federal Reserve began to formally target inflation in 2012, it chose as its measure the price index for personal consumption expenditures, otherwise known as the PCE deflator, rather than the Consumer Price Index, or CPI. Both measures go back to the late 1940s. So what's the difference between the two? The PCE deflator arises from a monthly report from the Bureau of Economic Analysis, and it's published toward the end of the following month. It tracks personal spending and income throughout the economy. The difference between the volume and value of spending is the price index, or deflator. Now, what is the attraction of the PCE deflator to the Fed over the CPI? It rests on a few key differences. For example, the CPI data is collected just for urban areas. The PCE deflator encompasses rural areas as well. The PCE recognizes that shoppers can and will substitute toward cheaper products. Healthcare and medical products are a much larger weight in the PCE deflator, that being about 22%, whereas it's just 8 to 9% of the CPI. The PCI also accounts for third-party payments like employer-funded health insurance, whereas the CPI just includes out-of-pocket medical payments. Finally, the CPI's weight for the slow-moving and difficult-to-measure shelter component is very high at 36% versus just 14% in the PCE deflator. Ultimately, the PCE deflator is a better measure of the cost of living versus the CPI, which measures the cost of buying. Over time, there actually hasn't been that much difference between the two rates. The PCE deflator has run at a rate about 1/4 to 1/2 percentage points below the CPI inflation rate fairly consistently. Now, for bond market participants and borrowers, it is the CPI that matters the most, of course. Specifically, in 1997, the Treasury of the United States adopted the Consumer Price Index as a standard for its Treasury inflation-protected securities, otherwise known as TIPS. The CPI is also the standard for the inflation swaps market that ensued from the early 2000s. The Consumer Price Index, usually reported by the Bureau of Labor Statistics during the second full week following the month of the survey, measures price changes for a fixed basket of goods and services in urban areas, and those weights are updated not every month but every year. The CPI's weights and methodology have changed significantly since the mid-1970s, and that's worth noting. For example, the CPI basket has gone from 2/3 goods to 2/3 services over that 50-year period. The weight of shelter has risen from 21% to a very high 36% of the CPI basket over that 50 years. Shelter prices for owned homes used to be measured by the cost of purchase, interest, taxes and insurance, but now it's measured as if the owner is renting from him or herself. Another difference is that food has fallen from 25% to only 14% of the CPI, although the eating and ordering out piece has been stable at around 5%. Energy has actually been rather stable at around 7% of the CPI, roughly equal between energy for vehicles, which is oil-based, and energy for homes, which is natural gas-based. That hasn't really changed. Finally, the weights for autos and medical have crept up, while apparel is down. Over the time, the CPI has also incorporated new technologies that have been disinflationary, including computing and internet services. It makes what economists and others call a hedonic adjustment to the price of many electronic items to account for these quality improvements, and that tends to suppress the Consumer Price Index. The higher percentage for services, the lower percentage for food, the evolution of tech, and the change in methodology for shelter inflation to delink it from rather volatile house prices have all contributed to a lower and less volatile CPI rate of change than Mr. Volcker confronted 50 years ago. Since Ben Bernanke's speech in 2003 regarding a 2% inflation target, CPI inflation has averaged 2.5% and the PCE deflator 2.25%. The expected inflation rate embedded in the US 10-year Treasury yield has averaged 2.1%. So, admittedly with the help of 2 recessions, this outcome is not too bad.